Welcome back to the channel, and thank you for spending some time with me today. I'm Algabot, your guide to the world of automated trading systems for MetaTrader 5. In this deep dive, we're going to study an expert advisor called the Swing Shelf Rejection Reversal. This is a pure price action strategy, which means it leans on no traditional indicators at all. Instead, it reads the raw structure of the market, the swing highs and swing lows that price itself carves out. By the end of this video, you'll understand how it spots a false break, how it confirms a rejection candle, and how it manages its stops and targets. Let's begin. So what exactly does this expert advisor do? At its heart, the Swing Shelf Rejection Reversal is a counter-move, or reversal, strategy. It does not use a moving average, an oscillator, or any calculated indicator. The only thing driving it is the natural structure of price, the swing points that the market leaves behind as it moves. The idea is simple to picture. When price prints a clear swing low, that low becomes a kind of shelf, a level where buyers previously stepped in. When price prints a clear swing high, that high becomes a shelf overhead, a level where sellers previously took control. The strategy treats these fractal swing points as the only support and resistance that price itself has actually drawn. Now, markets often reach just beyond one of these shelves before turning around. Price might dip a little under a swing low or poke a little above a swing high, and then close back inside the prior range. That behavior is sometimes described as a spring below support or an upthrust above resistance. This expert advisor is built specifically to study that false break behavior, but only when it is confirmed by a clean rejection candle with a dominant wick. Because everything is derived from candle geometry, the strategy is timeframe agnostic. It can be applied to whatever chart time frame is selected, and it can be studied across forex pairs, indices, or metals. The default settings use a swing lookback of 3 bars on each side, a reward-to-risk ratio of 2, a wick ratio of 1/2, a stop buffer of 15% of the signal candle's range, and a fixed lot size of 1/10. This style tends to appeal to traders who enjoy structural, rules-based setups and who like the clarity of a fully mechanical entry. Remember, though, that this is educational information only. Trading carries real risk, and losing trades are a normal part of any approach. Let's walk through the exact logic, step by step. The expert advisor works on closed bars, acting once per bar rather than reacting to every tick. On each new bar, it first looks for a confirmed fractal pivot. A candidate bar sits a number of positions back equal to the swing lookback, so it has an equal number of neighbors on each side. If that candidate's high is greater than every neighbor's high to its left and right, it is confirmed as a swing high, and its high price is stored as the resistance shelf. If its low is lower than every neighbor's low on both sides, it is confirmed as a swing low, and its low price is stored as the support shelf. With those shelves in memory, the strategy then examines the freshly closed candle, which it calls the signal candle, looking for a rejection. For a long setup, it checks for conditions together. The candle must be bullish, meaning it closes above its open. Its low must reach down to or below the support shelf, showing the false break. Its close must come back above that support shelf, showing the rejection. And the lower wick, measured against the full candle range, must be at least as large as the wick ratio, confirming that sellers were pushed back. When all 4 are true, the strategy signals a long entry at the ask price. The short setup is the mirror image. The signal candle must be bearish, closing below its open. Its high must poke up to or above the resistance shelf. Its close must fall back below that resistance. And the upper wick must meet the wick ratio threshold. When those align, the strategy signals a short entry at the bid price. Risk control is built directly from the candle. On a long, the stop loss is placed just below the signal candle's low, with a small buffer equal to a fraction of the candle's range. The distance from entry to stop becomes the defined risk, and the take profit is set at the reward-to-risk multiple of that risk above entry. On a short, the stop sits just above the candle's high, and the target is the same multiple below entry. The expert advisor holds only one position at a time per magic number, and once a shelf produces a trade, that shelf is cleared so it is not reused. Let's read through the code as if we were sitting in MetaEditor. At the top are the input parameters. SwingLookback sets how many bars sit on each side of a confirmed pivot. RewardRisk defines the target as a multiple of the measured risk. Wick ratio is the threshold that the rejection wick must meet relative to the candle's range. Stop buffer fraction adds a small cushion to the stop, expressed as a fraction of the signal candle's range. We also have a fixed lot size and a magic number. Now look at the long block. The condition checks that a support shelf exists, that the signal candle closed above its open so it is bullish, that its low reached at or below support, that its close came back above support, and that the lower wick divided by the range meets the wick ratio. When all of that is true, the entry is read from the ask price. The stop is set just below the candle's low minus the buffer. The risk is the distance from entry to stop, and the take profit is entry plus reward risk times that risk. The trade-by call then sends the order, and the support shelf is cleared. The short block mirrors it exactly. It requires a resistance shelf, a bearish candle, a high reaching at or above resistance, a close back below resistance, and an upper wick meeting the ratio. The entry comes from the bid, the stop sits just above the candle's high plus the buffer, and the target is that same multiple below entry. The trade.sell call places the order, and the resistance shelf is consumed. Let's bring the logic to life on the chart, candle by candle. Notice there is no oscillator panel here, because this strategy reads structure alone. The two dashed lines are the shelves price has drawn for itself, a green support shelf near 1.0840, and a red resistance shelf near 1.0900. On the left, price is drifting lower. As it slides into that green region, one candle prints a clear swing low, tapping down to the support shelf and then turning. Over the next couple of candles, price lifts away and rallies upward. Those neighboring bars on each side are exactly what confirm the pivot, locking that swing low in as the active support shelf the strategy will watch. Then price rotates back down to retest it. This is where the setup completes. The signal candle dips its low beneath the support shelf, reaching just below 1.0840, but instead of closing weak, it snaps back and closes above the shelf as a bullish candle. Look at that long lower wick. It dominates the candle, and that is the rejection the strategy requires. Sellers tried to push price under the shelf and failed. With the bullish close, the close back above support, and the wick meeting the ratio, the long entry is signaled, marked here as by entry. The stop is tucked just below the wick low, defining the risk. The take profit is placed at twice that risk above entry. From there, price climbs steadily. Each candle pushes higher, away from the shelf, until it reaches the take profit level near 1.0895, where the long position closes for a gain in this illustration. Notice how the move respected the structure. The false break trapped the late sellers, and price ran the other way. Now watch the right side, where the mirror image plays out. As price reaches up near the highs, it prints a clear swing high right at the red resistance shelf around 1.0900. Price pulls back, confirming that pivot, then pushes back up to challenge the level again. This time the signal candle pokes its high above the resistance, reaching toward 1.0910, but it cannot hold. It closes back below the shelf as a bearish candle, leaving a long upper wick overhead. That dominant upper wick is the rejection on the short side. Buyers reached above resistance and were turned away. With the bearish close, the close back under resistance, and the upper wick meeting the ratio, the short entry is signaled, marked as sell entry. The stop sits just above the wick high, and the take profit is set at twice that risk below entry. Price then rolls over and declines, candle after candle, until it reaches the lower target near 1.0850, where the short closes in this example. Both sides follow the same simple principle: a false break beyond a shelf, a confirmed rejection wick, and a stop and target measured directly from the candle. Keep in mind this is an idealized illustration. Real markets also produce setups that fail and reach the stop instead. And that brings us to the end of our study of the swing shelf rejection reversal. We looked at how it treats swing highs and lows as support and resistance shelves, how it waits for a false break followed by a clean rejection candle, and how it builds its stop and target straight from that candle's geometry. We also read through both the long and short blocks in the code. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation. Trading involves real risk, and losses are part of the process. If you found this breakdown helpful, please consider liking the video, subscribing for more MetaTrader 5 strategy analyses, and leaving a comment with the strategy you'd like me to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.